Hello everyone, welcome back to part 2 of chapter 9 discussion. We're talking still about tax credits. We have moved on to the child tax credit. So this is the one that was introduced way back in chapter 1 as as kind of a sample credit, and so that we could know how it fit in the in the tax equation. So now we get the ins and outs about how it applies. This is for children age 17. So qualifying child, back from our definition of that back in chapter 2. Okay, the child must be a U.S. citizen or resident. It has to be younger than the person claiming the credit. So children, okay. Now remember, qualifying child is broader than just children. Grandchildren can qualify and things like that. Okay, but it is somewhat limited. Each child $2,000 until they are 17. Okay, the year they turn 17, it's over. So the last year they get it is the year that they are 16. So they have to be under 17. It's phased out over limits. The limits are pretty high, but they are phased out. It is, so we talked about refundable versus non-refundable. This one is both. It's refundable up to $1,500 per child. The other $500 is only non-refundable. Okay, so you'll sometimes see it counted as the additional child tax credit, because that's the part that is refundable. So, and then once they get to be 17 and on through time, as long as they're a dependent, there is $500, but that is non-refundable for them. So again, we would take that before we count any refundable credits. So that is referred to as the other dependent credit, because it is obviously much less than the $2,000 for under 17. Okay, and this is for any kind of a dependent, right? Doesn't have to be a qualifying child either. Okay, so we're looking at the phase out range. Pretty high, $400,000 for married filing jointly, $200,000 for everyone else. Everybody else is lumped together, so really only 2 phase outs. And the way the phase out works, it's reduced by $50 for each $1,000 or fraction thereof they go over the amounts. So it's not like some of these others where there's a range. It's going to depend on how much of how many kids you have, how long it takes for it to phase out, because it's phased out by $50 for every $1,000 you're over. So someone with 3 children is going to take longer to phase out than someone with 2 kids. Okay, so single taxpayer, $217,000. So we're over the threshold by $17,000. Okay, 1 qualifying child. Okay, so we're going to reduce it by $50 for 17 times. Okay, so we take 17 times 50. That's $850. We subtract that from the $2,000 that we would have gotten if we didn't have any phase out, and our tax credit would only be at $1,150. Now, what if it had been $217,005? Always round up when calculating this. It's for any fraction thereof. So for that, even though that's only $50 more, that's another $1,000 reduction, because we always round up. So instead of 17, it would be 18. That's a pretty serious increase in the phase out for just a few dollars of extra AGI. So it's a pretty serious phase out range. This disappears, but on the positive side, it doesn't start till pretty high. Okay, so patent needs to have 2 qualifying children, ages 11 and 8, filed jointly. Their AGI is 112. Okay, $2,000 for a child, $4,000, not or close to the phase out amount Okay. Oh, of 400,000 is what that should say. Okay, because they are filing jointly. Okay. Child tax credit only under 17, can't be 18. Okay. Glenn's unemployed widower. Okay, that means he's single. Okay, is unrelated to Fred and Marlene, has lived the entire year in their residence between jobs, and Fred and Marlene pay all their living expenses. You can claim a $500 credit for other dependents for Glenn, and the answer is yes. Okay, he is a dependent. Okay, assuming he is younger than them. Okay, all right, $500 for other dependents. He qualifies as a dependent, even though he's not related, because one of the definitions of qualifying relative is that if they're not related to you, they must live in the home all year, and that's what's true, and they provided the support. All right, retirement savings credit, contribution credit. This is one of the situations in the law. They're so anxious for you to save for retirement that this is a situation where there is what we call double dipping, meaning you get a deduction and a credit for the same dollar amount. So when you make a contribution at work, your employer takes it out of your check. That's not counted as income, and you put it in a 401k or some other type of retirement plan, okay? And this is any type of retirement plan, Roth or what, doesn't matter, okay? And we'll learn more about that in those in Chapter 11. But as long as it goes into a retirement plan, then you get a credit, okay, for a certain percentage. Again, not the 100%, but a certain percentage of what you put in. And the maximum that you can consider, no matter how much you put in your retirement, is most that you can consider is $2,000. Okay, so, and your percentage that you get as a credit depends on your gross income, your modified gross income. And we'll see those percentages over here. Notice that this is pretty low phase out, meaning it's gone by the time your joint filer is at 68, head of household at 51, and everyone else at 34. That's pretty low, right? And they go quickly. So you get a 50% of the amount as a credit if you make a contribution to your retirement. If you're joint between 0 and 41,000, as soon as you go over 41,000, it drops all the way down to 20%, and at 44,000, it drops all the way down to 10%, and then it's 0 by 68. So pretty serious drop off in the credit amount or percentage. So Rike and Lupe have AGI 52. They're married and filing jointly. Okay, $1,500 in a year. How much is their retirement savings credit? They're all the way up at 52. They're already down to 10%. Remember, they got a little bit more before they get 0, but they're still only at 10%. Head of household 26 makes $2,200, but you can only consider 2,000. So the income's low enough, it's still at the 50% range, but we take only the 2,000 counts, so the $1,000 for the credit. And that is, by the way, that is a non-refundable credit as well. Adoption credit, this is a credit for expenses paid for adoption, okay? And the idea is that you pay the amount and then for adopting a child, and then you get a reduction in your tax liability, right? 100% of the qualified adoption expenses paid. There's a phase out, of course, from between $223,000 for married filing jointly up to $263,000. It's a $40,000 phase out range, and so again, you calculate how much you phased out based on how much you're over the bottom threshold, how close you are to the top threshold. So Levi and Isaiah incurred the following expenses in adoption of their infant daughter, which was finalized in 2022. 2021, they spent money. So even though you spent money in 2021 and 2022, it becomes finalized in 2022, that's when you take the credit, but you get to count the expenses paid in a previous year. Okay, if they're 2021 and 2022, just income is 220,000. Okay, they don't claim anything in 2021, but 14,750. Okay, in 2022, that's the total. It's under the threshold. Okay, they did not exceed the limit, and their income is not high enough for their phase out to apply. This couple spent $16,000, which is over, okay, the threshold. So we only use that $14,890, right? And then we have to deal with the phase out because their AGI is much higher, okay? And so we have phase out, and so our actual credit, okay, is going to be $10,203. All right, we're phasing out the rest of that. Earned income credit, perhaps the most common or one that gets the most press of all the credits. Okay, it is refundable. It's very valuable for those who have lower incomes. Okay, you have to know their filing status: married, head of household, single. Okay, the number of qualifying children. Okay, it is possible to get the credit with 0 children, but it's very low income levels. Okay, and earned income. This is a situation where the credit is actually increased as your earned income increases until you reach a particular level of income. Then it's the same for certain levels, and then it starts to go down as your income gets even higher than that. Okay, that's how it works. So 0 earned income gets 0 credit. So you need to have some earned income. Wages, salaries, tips all count as earned income. And at some point it's gone as your income gets too high. Okay, if you have investment income in excess of $10,300, you are ineligible, regardless of what your earned income levels are. So if you've got enough money in the bank that you can earn that much in interest, then we don't consider you in need for this credit. So this is a maximum amount you can get. Okay, if you have 1 child, 3733, 2 children, 61, 3 or more, 6935, and no children, 560. Okay, then of course it phases out, changes based on your filing status and source, but that's the maximum you could receive. So Josh and Danielle both work and have 1 qualifying child. Their earned income was $20,000. Okay, so if you use the EIC tables at the end of the chapter, not at the end of the textbook, at the end of the chapter, you do 2 things. You look up their earned income and you look up their AGI. Now in this case, this is the same number. So when you have a situation where the AGI and the earned income are different, you look at both of them and you take the lowest of the 2 is the earned income credit. Okay. Also, you can calculate the formula shown in the textbook. Okay, at income of $32,000, we start with the maximum credit. Okay, and then we subtract out because they're over where the limit starts to apply. Another thing to practice. Okay, you look up the 16,000. Okay, using either the credits or use a formula. She's at the maximum either way. Okay, she has that credit and her tax liability is $800, so her net refund is $53.64. Just the idea that it's refundable, so you get back if it's more than what your liability is. Now you would already would have applied any non-refundable credits to her tax liability before using this refundable credit. All right, the last one is premium tax credit. This is a situation where you have bought insurance through the marketplace and your income is between 100 and 400% of the poverty level. Okay, then you get a credit equal to how much the difference between what you should pay based on your income and percentage of income that you should pay on health insurance and what you actually paid. Okay, typically this happens directly against the premium. So you go in, you tell your health people that you're buying health insurance from, your insurance broker, you say, this is what my income is going to be next year. Okay, they say, okay, with that income, this is the insurance policy you should buy. Okay, this is how much you'll have to pay for it, and this is how much it actually costs, and we will give you a credit for the difference, and we'll apply that. We'll apply to the federal government for you, so that our insurance company gets paid directly from the government, the difference between what you're paying and what you should pay. Okay, and then at the end of the year, you see if that was the right amount. And if it's because your income is different from what you said it was, you could end up having to pay it back or getting more of a credit on your tax return.